Okay, we're working number 5. This one's a little bit harder, I think. And I'm not so sure my answers will be perfectly paralleling the answer manual. And I'll tell you why. There's many implications to these questions. I mean, if you go look in the answer manual will be right, and I'll be right, because there's more than one implication on these. So I might answer it and have a different, again, the question here is this. If you're thinking about taking the standard deduction, remember what the standard deduction is for me? $12,200. Or itemizing. Now, itemizing is where you have to go out and find all your deductions. Remember what they were? They were like interest on your mortgage, income taxes, state income taxes for the state, medical expenses, medical expenses that were not reimbursed. What you're trying to do is you're trying to get more of these. In other words, you get to take the greater of these two. This is a deduction, and the game is played that you want to get the bigger of the two. So 12.2, if you take itemized, you want to try and come up with $12,201 more than this. And if you get that, you hope to get that. Now, what implications? Well, I don't know. Let's see here. Let me do this. All right, the age of the taxpayer. Well, I guess the only thing I can think of is if the taxpayer is old. If they're old, let's just put that. If old, they get $1,650 more. That's called the additional standard deduction. They get the additional standard deduction. So if I was 65 or older, I could add that. And then I'd get, what did I say, $13,850. By the way, if I was old and blind, I could get even more. All right, so the age of the taxpayer. Also, another thing I'd say, if the taxpayer's old, you have a better chance of maybe getting the itemized. Because remember, when you're old, what happens? Medical. You might have a lot of unreimbursed medical. So you could say the age of the taxpayer, if you're old, you get the $1,650 more, the additional standard deduction, versus you might get more medical, though. Medical expenses if you're old. The health of the taxpayer. Well, maybe that's what they're referring to, but the health, I would say, again, on this one, that, again, poor health means it's likely that you'll get the itemized. Remember, itemized, you can take medical expenses. So if you're in poor health, then I think it's very likely that you might itemize, because again, you'll have more medical deductions. Remember, if you have poor health, you don't get anything extra for the standard. Whether the taxpayers rent or own their residence, well, if they rent or own their residence, if you own a residence, then you'll get your itemized deduction because you can deduct the interest on a mortgage. So this one does have an effect. Again, if I would say this, let me change colors here. If you own a house, that will favor itemizing. Again, what effect, if any, does each of the following have? I think this tells you the effect is, if you own a house, it favors itemizing. Because again, you can itemize, you can take the interest mortgage on a house. Taxpayers' filing status. Well, if you're single, your standard deduction is $12,200. If you're married, you get $24,400. If you're filing jointly, married, oh, that is it, single. So again, this does affect the standard deduction. It doesn't affect, well, the taxpayer's filing status, I would say, what effect does it have on each of these? The taxpayer's filing status, I would just say, it changes the standard deduction. That is the implication. It changes. Again, if you're single, you get 12.2. If you're married, you get 24.4. If you're head of household, I think you get 18,000 something. So the implication there, what effect, if any, does this have on these? Well, it changed, again, if you're single or married or head of household, it changes the standard deduction. I would say that if you have a greater standard deduction, there's less chance you'll itemize. All right. What about, again, on this one, whether the married taxpayers decide to file separate returns? Well, there is a rule that says if you file separate returns, you must do the same on each return. What do I mean by that? If you decide, your wife and you decide to file separate returns, and she itemizes, you have to itemize. Or if she takes the standard, you have to take the standard. So this does, what effect does this have? Well, if you decide to file separately, you must do the same on each return, which means, again, you either have to itemize or you have to take the standard. But you must do the same as your spouse. The taxpayer's uninsured personal residence was destroyed by a wildfire. Well, do you remember I don't know if you remember this, but we call those casualty losses. That's called CASUALTY. That's a casualty loss. You cannot deduct that if you take the standard deduction. The only thing you get on the standard deduction is it. Nothing else. But guess what you can do? You can deduct it as an itemized deduction. So a casualty loss, it says what effect, if any? A casualty loss means that you would favor itemizing. Because if you lose a whole house, again, an uninsured personal residence, that's going to be a big deduction. So I would say there's a casualty loss means you'll favor itemizing. You'll get more, because you might have a $200,000 loss over here to take. The number of dependents a taxpayer can claim, well, really that doesn't matter anymore because you can't claim dependents. But anyway, this one actually has no effect. It doesn't matter. No effect on whether you itemize or let's just do STD. There's no effect on whether you itemize or take the standard deduction. We could do STDD, standard deduction. Yeah, because you'll get the same number of dependents. If you got 3 kids, you got 3 kids. It doesn't matter. You can take a standard deduction, you got 3 kids. And if you itemize, you've got 3 kids. So there's no effect there. You get the same under each. This is kind of a hard one. It's more of a, you really have to be familiar with the tax laws to get that one. If you're not good at that one, don't feel bad because you're brand new to this. This is a short problem or a small one. I put it on here on purpose. It's just good to know this because I actually have had a lot of people that are divorced that I've known over the years, and this comes up. But when you get divorced, and again, Mark has custody of their children, but Lisa provides nearly all of their support. Who is entitled to claim the children as dependents? Well, again, I've had this happen a lot over the years, and usually, I'll be honest with you, many times the spouse who provides all the support, they tell the other spouse, hey, I get the deduction for these children, but you don't. The deduction always goes to, again, the parent who has custody. I'll tell you why. Because it's hard, and Congress recognizes that. Congress says, man, I don't care if you support those kids. Having the kids in your house, that's harder. Well, I don't know, both are hard. But again, Congress considers that more of a burden, to have the children in your house, to feed them all day, watch them all day, try and educate them. So they give the deduction, naturally goes, the dependency deductions, or exemptions is what they call them, I think. Goes to, again, the custodial parent. All right, and 14, this one I think is going to get a little bit harder. Yeah. I don't know. This is, again, some of these, they're getting pickier now. In 14, do you remember we said there's several categories of filing status. And again, filing status, let's go name them real quick. There's single, There's married. By the way, we'll do filing joint. Married filing jointly. There is married filing separately. There is head of household. And then the other one is, I call it a qualifying widower. Is that really right? Qualifying widower or surviving spouse. Actually, I kind of feel like there's another one too. There's called an abandoned spouse. But again, let me just show you real quickly. Let me wrap these up. If you're single, guess what? You use the single rates. Remember we said there's, what did we say there were? There's the single rates. There's the married filing joint rates. There's the married filing single rates. There's 4 rates. And then there's, what did we say? Head of household. There's 4 rates. Well, if you're single, you use the single rates. If you're married filing joint, you use the married filing joint rates. If you're married filing separately, there's a rate for that, married filing separately. If you're a head of household, there's head of household rates, so you've got that. But what if you're a qualifying widower? They don't have rates of it. A qualifying widower is somebody whose husband just died or wife, and they get the married filing joint. That's a very good deal. Again, if you're a qualifying widower or a surviving spouse, that's the same thing. You get the married filing joint. Those were the best rates. Let me make sure my camera's catching all this. Yeah, it is. Okay. And what if you're an abandoned spouse? Well, if you're an abandoned spouse, you really don't want to be an abandoned spouse because then you'd have to do what? You're one person, you'd have to file as single. Single's the worst rate. Do you remember that? So you don't want that rate. You'd say, well, you know what, I'll take any of the other rates. Well, really not any of the other rates. You really, as an abandoned spouse, you'd always like to get the married or the head of household. And an abandoned spouse will get head of household if they can. They'll get that if they have a dependent. But now, those are all the rates. It says, again, those are all the filing statuses, at least to my knowledge. There's probably more, but I don't know them all. But at least those are the ones I know. Comment on the availability of the head of household filing status for 2019. In other words, in these situations, does this person qualify? I'm going to go ahead and erase this because I need to put up some other stuff. So one good thing about having it on tape is you can always just rewind that or stop it if you want it. But to be head of household, let me see if I can go back and get it. To be head of household, you need to have a house and you have to pay 1/2, greater than 1/2 of the money to maintain the house. What would that be? Heat, light, utilities, the mortgage on the house, repairs to the house. So again, one of the things to be head of household, you have to, all right, I ran out of memory. Let's see if we can pick this up. I don't remember where we left off, but this question is asking, do these people qualify for a head of household status? To be head of household, you have to pay over half of the money or expenses to maintain a house. Let me see. 2, you have to have a dependent live in the house, and it can be a qualifying, Q-U-A-L-I-F-Y, qualifying child, or it can be a qualifying relative. Hang on a second.
Parker?
What did I say? That you have to have a dependent live in the house. The dependent can be a qualifying child or a qualifying relative. And 3, the dependent must live in the house for over half the year. All right, those are the criteria. Let's see if we can do these. I don't know if that's going to be enough. And I'll tell you why. Oh, we ought to write these up here too. What's a qualifying child? Let's go up here and draw an arrow. A QC, qualifying child. 1, they're a relative. That means they can be a daughter-in-law, son-in-law. It could be niece, nephew, I think, brother, sister. Actually, the list is quite lengthy, but a relative. We'll get into the ones. The ones that don't qualify are aunt, uncle, and in-laws. I hope I didn't just contradict myself. 2, and by the way, sometimes these are easy to remember by an acronym, RRAS. They have to be a relative. They have to reside in the house. Let me see, 3 and 4. Let me see, their age. The age requirement is 19 or 24 if a student. And they have to be less than that. Let me see, support. They can't be self. You know what I'm going to do? I'm not going to. I'll read these to you in a second. I'm going to write them up on the board. It takes too long. Okay, I've written the rules up here for a qualifying child. In other words, what is a qualifying child? A qualifying child, I don't know if this will help you, but it's a RAS. They have to be, obviously have a relationship, or be a relative. So it's called the relationship test. It includes most people. It does include aunts or uncles or cousins or in-laws. Those are the exceptions, but just about everybody else. You have to live in the house over half a year. They have to be less than 19 or less than 24 if they're a student. Support, the person that is your child can't be self-supporting. That means they can't provide over half their own support. Now, if they aren't a qualifying child, they could be a qualifying relative. A qualifying relative, the test is RGS, which is relationship. Literally anyone will meet the requirements for the relationship. I think, there's a few exceptions, but most people will meet the criteria for the relationship. They also have to have gross income less than $4,200, and you provide over half the support of the relative. By the way, do you notice there's no age requirement down here? And also, you don't have to live. A qualifying relative doesn't have to live there. So anyway, these are what a qualifying child and qualifying relative is. And you see again why the tax laws are complex, because it says to be a head of household, you have to have one of these. You have to have a qualifying child or a qualifying relative. But if you do, then you can get those better rates. All right, let's take a look at these. Let me see. It says, and we're trying to decide, does this person meet the criteria for head of household? Do they have a house and pay for more than half? Do they have a child or relative that lives with them? And does the dependent live in them for more than half the year? By the way, you'll have to go read these in the textbook. This is an outline, but there's much more detail. In other words, you're really going to have to go read. What is the relationship test, and who meets that criteria? Who are the specific the relatives who meet this test? In this test, you can have a member of the household, just somebody that lives with you, meets the test. So it's pretty flexible and liberal there. Taxpayer lives alone. That doesn't sound good. But maintains the household of his parents. In July 2019, the parents used their savings to purchase a new BMW. Well, I don't have that exception up here. See, I've written a lot of notes on the board, but there is an exception. You can have a qualifying relative and get head of household status if it is a parent. Let me see. In other words, you see it says the dependent must live in the house for over half the year. That does not apply to your parents. If you provide over half the support for your parents, again, then that is a qualifying relative down here. It's not a qualifying child, because your parents are too old. You know, they're going to be older than you. They're not going to make it as a qualifying child. But again, you've got a house, they've got the qualifying relative, and again, the dependent must live in the house. There's an exception if it's your parents. Now there is one thing here, and I'm just going to go ahead and say yes. Yes. Yeah. I'm going to say yes, this will meet head of household. Yes. I think your author says maybe not, and I'll tell you why. You see, it says here that the parents bought a BMW, and one of the criteria of being head of household is you have to provide, remember, this is not going to be a qualifying child. Like I said, is your parent a qualifying relative? Yes. They meet the relationship test? Yes. What did they say? They didn't have much gross income, did they? Household parents used their savings. They probably had no income, so they didn't violate this. And you provide over half the support. Well, if they just bought themselves a BMW for $62,000, then that's, let's again, what's, you know, again, if their support, they paid all that. So to qualify for you providing over half the support, you're going to have to give your parents, not give them, but pay for food, utilities, clothing, and you know how much you have to pay? $62,001. Because $62,001 will beat this. And then you'll be what? If you give 62, it's half-half. You see? 62 and you not donate, but provide 62,000, then it's 50-50. But you got to be, you got to provide over half the support. Well, you know, this is kind of foolish that your author does this, but all you have to do is, you know, you can get around that. Just again, have the have the parents, your parents give you a $62,000 gift, and then you take the gift and buy them a BMW. That'll get you around this law, and I think that's pretty legal. So anyway, yes, you'll make it. Again, let's just pretend that you do. In fact, you pay $62,001 to support them that year. Heat, light, utilities, food, whatever. And if you don't do that, then just tell them, hey, don't go buy that BMW. Just give me the money. So they give you the money as a gift, which is, remember I said earlier, that's non-taxable. Then you go out and buy the BMW for them. You got that covered. So yes, head of household. Taxpayer maintains a home in which she and her dependent father live. Okay, that sounds good so far. The father enters a nursing facility for treatment of a mental disorder. Well, they don't tell you how long, but as long as the father, let's just change, the father enters a nursing facility. It says for treatment, it doesn't say permanently. Let's just say the father enters a nursing home, temporarily. Father enters a nursing home temporary for treatment of a mental disorder. Yes, you can get head of household. Again, here, taxpayer, they got the home, they're maintaining it. They got the dependent, it's a qualifying relative. Now, I would tell you the answer is going to change. If that father goes in there for a mental disorder, again, then no, again, in that case, the only way you'll get head of household is if you go ahead and pay for over half the cost to keep them in that facility. You with me? So if they do go permanently into a nursing facility, you're going to have to pay what? You're going to have to pay over half the support. But let's just say they went temporarily. Taxpayer, single parent, maintains a home in which she and her unmarried son live. The son, age 18, earns $5,000 from a part-time job. Alrighty, well 18, that's okay, isn't it? This is a qualifying child. The son meets the relative test, residence in the house, age 18, that's fine. And support, does it say she supports him? She and her unmarried son, the son is age. Now the $5,000 doesn't come into play because the son, that test is only over here for a relative, for a qualifying relative, and there's no income test here. So this is fine. So yes, This will meet head of household. Assume the same facts in part C, except that the son is age 19. Uh-oh, that's bad. If the son is age 19, it violates. The son cannot be a qualifying child. He's too old. And they didn't say he's a student, so it bumps him down here. He can be a qualifying relative. He's a son, but his gross income is over $5,000. So now he can't be a qualifying relative either. So now guess what? This is no. D is no. No. Not head of household. No. It's because of that age. See, the age, he's too old to be a qualifying child, and he makes too much money, $5,000, to be a qualifying relative. So she has the house, but she doesn't have a dependent, according to the tax laws. Taxpayer is married, maintains a household in which he and his dependent stepson live. Taxpayer is married and maintains a household in which he and his dependent stepson live. I don't see anything wrong with that. Taxpayer is married and maintains a household, okay, got that, in which he and his dependent stepson live. Stepson is fine. Again, that's again, I don't see anything wrong with that. Yes, I say again, there's a trick there, I don't know it. Yes, this is head of household. Let's run through them real quick. Okay, paying for the house, dependent stepson. A stepson is considered a son. That's a qualifying child. They don't say there's any issues there. And again, dependent must live there. It says the stepson does live there. I see that meets all the criteria. Taxpayer lives alone, but maintains the household where her dependent daughter lives. Okay, well, yeah. No, that's not going to make it, I don't think. Let's see. Again, the taxpayer lives alone. She, again, has the household. She has a qualifying that where a dependent daughter lives, but maintains the household where a dependent daughter lives. Okay, the daughter is a relative. That's right, the gross income, she doesn't say it's going to violate that. They don't give you the income. You provide over half her support. Okay, that's fine. But again, the dependent daughter must live in the house for more than half a year. So it's the violation of the three. So no. No. No head of household. Okay? Because again, remember, the dependent must live in the house for over half the year. There is an exception if it's your mother and father, but it isn't for a daughter. The exception doesn't apply to a daughter, just for a mother and father. Taxpayer maintains a household that includes an unrelated friend who qualifies as his dependent. Taxpayer maintains a household, okay, they got this, got the household, includes an unrelated friend. Is that a qualifying child or qualifying relative? No. Who qualifies as a dependent? Well, there is a rule that says you can have a qualifying relative and they don't have to be related to you. They can just be a member of your household. Let me give you an example. When I was in high school, a friend of mine lived with his coach because his parents abandoned him. They took off and they went back to France. They were French, and his mother. I don't ever know I never got to meet his father. Nobody ever knew who his father was. But anyway, his mom took off to France and left him here in the United States. So he went and lived with a coach at the high school. And the coach, again, is that boy a qualifying relative? Well, there's no relationship between the coach. The gross income test, he didn't violate that because this friend of mine had no money. And did the coach provide over half support? Yes. And there is a criteria that says if somebody just lives with you, you can get qualifying relatives. So, is this a qualifying relative? Taxpayer maintains a household that includes an unrelated friend who qualifies as a dependent. That is a qualifying relative. And that person can count that person as, well, in other years they could count them for an exemption. But they are a dependent. But guess what? In this rule, this taxpayer, no, because again, it's an unrelated friend. They wrote this rule, you can't be head of household. In other words, that exception does not apply to this tax rule. That is a qualifying relative. But Congress wrote in this tax rule that they will not give you that exception. They will not give you the member of a household. So this is no. No, not head of household. So no, not head of household. Okay, that's a tough one. But you see, the whole point here is these are how complex the tax laws are, and you want the head of household. You'll get the lower tax rates. Okay, I made a mistake on one of these. I don't know if you can see it, but it's E. Married. Taxpayer is married. Well, if you're married, you're not going to get head of household. If you're married, you're going to use what? You're going to use married, and you're going to file joint. To be head of household, you can't have a spouse. To be head of household, you got to be single. So again, this one, the answer is they're going to do married, filing joint, but no, not head of household. No. Sorry about that, but we're all okay now. All right, on to 15. 15's kind of smaller and not so hard, but it says, in many cases, a surviving spouse will ultimately become a head of household. Now remember, the most desirable rates are married, filing jointly. The second most desirable rates are head of household. The third and the worst are single. So you're always trying to get, if you can, into these more desirable rates. Now, do you remember that surviving spouse? Do you remember what a surviving spouse gets? A surviving spouse gets the best rates of all. Surviving spouse for the year of death, plus 2 more years. Now, to get surviving spouse, I haven't talked about that, but it's very much like head of household. Surviving spouse, your husband, you get, if your husband dies or your wife, in the year of death, you get to file as married filing joint, which is very desirable. But you can do it for 2 more years, married filing joint, if you live in a house, and again, you provide over half, you pay over half the expenses for the house, and you have a dependent, a child or relative. So again, a surviving spouse has to have a qualifying dependent. And anyway, it says, in many cases, a surviving spouse ultimately becomes head of household. For filing status purposes, explain the statement. Well, do you see that it's very natural that, again, after the 2 years expires, the death of your spouse comes, and you married, file joint. Then you get 2 years if you have a child or a dependent, qualifying relative or a child. You can get 2 more years of married, filing joint. But what's the next best rate? After that, you can't be married. It's been too long. But your next desirable rate is head of household. Well, again, if you were a surviving spouse, there's a very good chance you'll be head of household because you will be a single individual, not married, and you'll have a dependent, qualifying child or qualifying relative. So this makes sense. Explain this statement. I would say the criteria for, I'll call it surviving spouse, are equal to the criteria for head of household. So the criteria for surviving spouse are equal to the criteria for head of household. Now, the way I wrote that, you might think, well, then why don't you do it? Well, because again, this is better. If you can get surviving spouse, you'll get that for what? Death plus 2 years, but then that expires. You can only get it for 2 years. Then naturally, again, if you have children or a qualifying relative, you'll take the head of household, which is your next best option. All right, that's 15. Let's take a look at 18. 18 does get a little bit into some more new stuff. Okay, 18, yeah, this is capital gains and losses. Oh, this is a little bit harder. Capital gains and losses, I think. Okay, Hernando has the gain on the sale of stock held as an investment for 10 months. Let's put a number on that. Let's say it's $1,000 gain, okay? That's $1,000 gain. And then he has gain on the sale of land, had as an investment for 4 years. Let's say that's a $2,000 gain. Let's put a number behind that. Gain on the sale of a houseboat owned for 2 years and used for family vacations. Let's make that a $3,000 gain. He had on the houseboat. Loss on the sale of a reconditioned motorcycle owned for 3 years and used for recreational purposes. Let's say he loses $4,000 on that motorcycle. Congress has passed laws called capital gains and capital losses, and they're special. Basically, capital gains and losses are taxed like this. They have special rates, and they're favorable. Congress passed these laws because they like it when you invest in stocks and bonds, and they're trying to encourage you to hold on to stocks and bonds and investments. And so they said, well, if you'll do that, if you go buy things like stocks and land, and again, that keeps the economy going in a way because you're providing money to corporations and realtors, and it's putting your money out there in investments. And Congress says, if you'll do that, we'll give you some special tax rates. And the special tax rates are this. There's 0. I can't remember what they are. I think 10%? I think the highest is 28. I'll have to look those up, actually. Give me a second. Let me look them up. Okay, these special rates, again, let me repeat that Congress, they can do what they want, and they can say, you know what, we want to encourage people to go out and invest in stocks and bonds and long-term assets and real estate, because that, again, encourages commerce. And so they said, you know what, if you'll do that, and if you make money, we'll actually tax that money at a lower rate. And they said, we'll give you a special rate, either 0 or 15 or 20, but these usually will always help you. In other words, let's say you're in a 20% tax bracket. You're not going to pay 20%. You'll pay maybe 0 or 15. You'll get the lower. Whatever bracket you're in, remember how I showed you all those brackets at the very beginning? You'll get these lower ones. But there's a rule, and there's lots of rules, but here's how it works. You find out if something's a short-term capital gain, or if it's a long-term capital gain, or if it's a short-term capital loss, or if it's a long-term capital loss. Capital losses, generally, for you guys, it's going to be on stocks, bonds, land. In other words, what is it? Capital. Capital is stocks, bonds, land, and other assets that you own. Your bicycles, your house, your car, those are all capital assets. And if you sell them and have a gain, now you might say, well, how do I know if it's a short-term or a long-term gain? Well, if you sell a stock, bond, land, or other assets, if you kept it, again, less than a year, it's short. It's a short-term gain. If it's more than a year, it's long-term. And again, there's even a lot more rules than this, but first of all, you have to figure out, is it a short-term gain or a long-term gain? If it's a long-term gain, you get the special rates. If it's a short-term gain, you don't get special rates. And if it's a short-term capital loss or long-term capital loss, you can use those to deduct from the gains. But first of all, you have to categorize these into their categories. And let's take a look. Gain on the sale of stock held as an investment for 10 months. All right, that is a short-term capital, gain. Gain on the sale of land held as an investment for 4 years. That's a long-term capital gain. Gain on the sale of a household boat. Houseboat owned for 2 years and used for family vacations. For 2 years, this is long-term capital gain. So we got some short-term capital gain, long-term capital gain, long-term capital gain. Loss on the sale of reconditioned motorcycle owned for 3 years and used for recreational purposes. Well, guess what? I told you that a motorcycle was another asset. It is a capital asset, but there's a law, and because it's a motorcycle, it's used for recreational purposes. Guess what you can do with that loss? Nothing. So let's just draw a line. We cannot deduct a loss on a personal asset. Now there's different rules. That's why taxes are so fun. But had you had a loss on a stock or a bond or land, you could deduct it. You can deduct losses on stocks, bonds, and land, but you can't deduct losses because these stocks, bonds, and land are assets that you've entered into to make money on. Again, they're assets that are based on business, on profit-seeking assets. But the motorcycle was a personal asset. So guess what? You can't deduct a loss. But remember the terrible rule? If you sell a motorcycle for a gain, you will pay a tax on that. It's taxable. So what do we do now? We've got $1,000 a short-term capital gain, $2,000 a long-term capital gain, $3,000. We combine like things. In other words, if you have more of these, you can just say, I'm going to combine these two. So the 2,000, I can say now that I have $5,000 of long-term capital gain, and I have $1,000 of short-term capital gain. And it says, how should Hernando treat these transactions for income tax purposes? Well, the long-term capital gain will be special rates. He'll get the special rates of 0, 15, or 20. Remember, you have to think of these in relation. Let's say that Hernando is a very, I'm going to guess he's Latino, but let's say Hernando is a very rich Latino and he's making lots of money. Let's say he's making $400,000 a year. If he's making $400,000 a year, he's probably in a 35, 40% tax bracket. But he won't have to pay 35 or 40%. He'll get the next lowest down. If he's in a 40%, he gets to take 20. Let's say it was somebody like me. I don't make that much money. Let's say I'm in a 16% tax bracket. If I'm in a 16% tax bracket, I'll get the 15. Let's say I'm in a 12% tax bracket, I'll get 0. I always get to have, the lower rate. In this case, the special rates will apply to the long-term capital gain. Guess what happens to, again, the $1,000 short-term capital gain? That's going to be taxed normally. So this is your answer to this question right here. How should he treat these? There's the answer. The answer is he will get special rates on the long-term capital gains of 0, 15, or 20, whichever is advantageous to him. By the way, there's really rates. You're going to have to look in your chapter. It's more specific than that, but there's very much specific. They'll tell you when you get to use certain rates. But the $1,000 of short-term capital gain, he does not get the special rates because he didn't hold it long enough. Remember, Congress likes it when you hold things a longer period. They're going to reward you for buying stocks and bonds and land and holding it for a longer period. All right, let's take a short breather and go to the next problem. Okay, we're going to work 21, and 21 is kind of hard. It goes back to the standard deduction. You remember what I told you earlier? Everybody gets a standard deduction. Well, here's the standard deduction. If you're single, you get 12.2 standard deduction. If you're married, you get 24.40. See, it's double. If you're head of household, you get 18.350. You remember, if you're old, you get an additional standard deduction. That's if you're what? Greater than or equal to 65. You can also get an extra one if you're blind. An extra standard deduction. Do you remember, again, if you're single and you're over 65, you get an extra $16.50. You add it to any of these. If you're married, well, not to any of them. If you're married, you add it to this one. And if you're head of household, you'd add it to this. Now, what if you're a dependent? This is for, again, single, married, head of household. This is for if you're elderly or blind. But what if you're a dependent? A dependent is not, you're not allowed to get the standard deduction. A dependent is a child. It's somebody else who, a dependent is someone who's being claimed on another person's tax return as a dependent. Well, they have special rules. You get a much lower amount of standard deduction. If you're a dependent... All right, I'm going to review that again because my battery went dead and I had to put in a second battery. Standard deduction applies to adults most of the time, And again, the standard deduction is, this is what it is for adults. Single, 12.2, married, 24.4, head of household. You can get an additional standard deduction if you're above 65 or equal to it, and this is what it is. But if you're a dependent, that means, again, someone else is providing for your expenditures and supporting you and giving you a household. Well, and they usually many times are claiming you on a tax return. Not anymore, but I don't want to get into that. If you're a dependent, you get the greater of $1,100 as your standard deduction. Notice it's much lower because, again, we don't expect children to make that much money. Or earned income plus $350. Earned income, let's say I mow lawns during the summer and I make $1,000 during the summer mowing lawns in my neighborhood. That's earned income. Okay, I think I got a good battery in it now. I hope I do. But if you're a dependent, you get the greater of $1,100. Again, because you're a child, you wouldn't be making much money. So you can get a standard, now that's a very small amount. Or you can get the earned income plus $350. Again, earned income, I'm a child and I go out and mow my neighbor's lawn and over the whole summer I make $1,000. I get an earned income of $1,000 plus $350. So that's $1,350, which is better than 11. I'll take the $1,350. Now, earned income is when you go out and mow lawns. It's when you bale hay. It's when you work in a restaurant. What's earned income? Well, there's another kind of income called passive income. Passive income is, again, where you make interest or you get dividends. You don't do any work, basically. You put money in the bank and you get some kind, let's again say your father makes some investments in oil wells, and the oil wells pay you royalties, but you don't do anything. You can sit on your bottom and get that money. That's called passive income, and that's not allowed. It's not passive income plus $350, it's earned income. That's where you actually move your body and work to do something. Now it's asking us what is the standard deductions in each of these. Let's see if we can get them. It says Ellie is 15 and is claimed as a dependent by her parents. She has $800 in dividends. Don't use that because we know dividends are passive income. That doesn't have anything to do with what we're doing in dividends, and has $1,400 in wages. She's a babysitter, let's say. Sounds sexist, doesn't it? In wages from a part-time job. What's her standard deduction? She's a dependent. She gets the greater of $1,100 or earned income plus $350. Her earned income, if you add $350 to it, it's going to be $1,750. So that's the answer. $1,750 is her standard deduction. That's the answer to that one. The $1,750 is her standard deduction. Remember, the greater of 11, her earned income plus $350. There's her earned income. Don't use those dividends. Those are passive income. All right, Ruby and Woody are married and file a joint tax return. All right, Ruby is age 66 and Woody is age 69. Their taxable retirement income is 10. Are these people dependents? No, they're not a dependent. Okay. Ruby and Woody are married and file a joint tax return. All right, well, if you file a joint tax return, you're going to get 24.4. So let's write that down. You get 24.4. And Ruby is age 66, and Woody is age 69. Their taxable retirement income is 10. Well, that doesn't have anything to do with it. So 24, but they're old. So they'll get the what? They'll get an additional standard deduction, and they'll get it, again, if you're married, you get $1,300. So they'll get two of them, plus $1,300 for Woody and another $1,300 for Ruby, and that's going to be 24, I don't know whether, this is going to be 26, 26, the 24, 27, 24, 25, 26, 27, I think it's going to be 27,000 even. Yeah. They'll get $27,000 of standard deduction for that. Because again, 1, 3, and 1, that's 2, 6. That'll give us, yeah, that's 2,700. They'll get $27,000 of standard deduction. Shonda is age 68 and single. She's claimed by her daughter, so she is a dependent. As a dependent, her earned income is $500 and her interest income is $125. All right. So Shonda is a dependent. She gets the greater of $1,100 or earned income plus $350. Her earned income and her interest income, we don't care about that interest income, that's passive income. So her earned income is $500. Take that plus $350 and you get $850. We want the greater of $850 or $1,100. Well, she'll take the $1,100. So she'll take $1,100 because it's the greater. Now she's older, isn't she? She's 68 and she's single. So a single person she can get this additional standard deduction of $1,650. So let's add that, $1,650, and that's going to be $2,750. So that's the answer on that one. She'll get a $2,750 standard deduction. Ruby and Woody get $27,000, and Ellie gets $1,750. What's in the fourth one? Frazier, age 55, is married, but he's filing a separate return. His wife itemizes her deductions. Well, there's a rule, and the IRS has got a rule that, again, it's to prevent abuse of the tax law. But if you're married and you're filing separately, you must do the same as your spouse. What I mean by that is, if you married and file separate, if your spouse itemizes, you must itemize. So guess what your standard deduction is? In this case, your standard deduction is, the answer is 0. You don't get a standard deduction. You get no standard deduction because you're going to itemize. Remember, you always get the choice. You can take the standard or you can itemize. But if your spouse itemizes and then you file separately, you must do the same thing. It's to prevent abuse, and let me tell you what you would do. If that rule wasn't there, just very quickly, you'd say, you know what, honey, you tell your wife, why don't you go out and itemize, and you, when you do your separate return, take all those itemized deductions and make them really big, get all that you can. Then I'll file and I'll take the standard deduction. Do you see, it's a really good deal. She gets all the itemized, I get the standard. So we're really getting both. We're getting to take the itemized and the standard. Well, they said you can't do that. You can take one or the other. So again, they're preventing an abuse. And they're saying that's why the rule is if you're married and file separate, you got to do the same. You either itemize or take the standard deduction. But you don't get to take both. All right, that's this one down. I think we're going to do one more and quit on this tape. But let me pause it. Okay, I'm going to go a little bit out of order just because of the way this works. But I'm going to do 25, which is a sign. It's a really easy one for me to do. And then I'll go do 23, but this is a computational, so I'll actually going to write this on the board and do the computations. But let's do this one. Rebecca sells her personal scooter for $550. She purchased the scooter for $700. So she pays $700. She sells it. She sells it for $550. All right. Her basis is $700. She sells it for $550. That's a loss. That's a loss of $150, isn't it? $556. Yeah, that's a loss of $150. Can she deduct that loss? Well, remember, if that was stock or a bond or land or real estate, she could. But that's not. That's not a capital asset. Well, it actually, I guess it meets the requirements as a capital asset, but the problem is it's a capital asset that's, again, it's a personal scooter. Well, a personal scooter, they will not allow you to deduct losses on scooters, bicycles, boats. Now, had she sold it for a gain, it'd be taxable. That would, again, be taxable as doesn't say how long she had it. Oh, 3 years ago, that'd be a long-term capital gain. All right, she also sells a painting. She also sells a painting for $1,200 that she acquired 5 years ago for $900. What are the tax implications of these sales? Well, again, this is one where she, again, gets a painting. She paid her basis. She bought it at $900. She sells it for $1,200. If it's 900, she sells it for 1,200, she's got a $300 gain, doesn't she? Yes. And that is going to be, that she acquired 5 years ago, that's going to be long-term capital gain, and that's taxable. So in this case, she's got a taxable gain, and she's got a loss, but look at how Congress is so much, they're not favorable to losses at all. They're not going to let you deduct it because it's on a personal scooter. Well, the painting, I guess painting is art, it is a collectible, so that is, a painting is going to be long-term capital gain because it's considered a collectible. But she would get at best a 28% rate on that. But I won't go into it more than that. Now, I'm going to go back and work this one, but I'm going to have to actually copy these onto the board. Let's just look at this. We're going to do 23. It says compute the tax liability. What they mean by that is compute the taxes. What do they owe the IRS? All right. And the marginal and average tax rates. The marginal rate is your highest rate. It's the rate that you're paid. And, you know, again, it's the rate that, again, you remember they're progressive. Well, if you're making a lot of money, you're not going to be at the 10% level. You're going to be at a marginal rate that's much higher than that. So again, the marginal rate is the highest rate you're in and paid. The average tax rate is one where you take all your taxes and divide by all, take all your taxes that you pay and divide by all your income, all your taxable income, and you get your average tax rate. Use the 2019 tax rate schedules to do this. Chandler, who files as single taxpayer, has taxable income of $94,800. Lazier, who files as head of household, has taxable income of $57,050. All right, try and remember this. I'm going to write it on one side of the board, then I'm going to write it on the other side of the board. But then we're going to go back and get those tax rate schedules and calculate the tax liability. How much do they owe in taxes? All right, we've got to get back. We're doing the 23. We're going to do some tax computations, but we actually have to get all the way back, and we need those tax tables, the tax rate schedules. And I think we have to go all the way back to the beginning. Here they are. And we need single, let me see, they said use the 2019, so this is what we want. Tax rate schedules, and we need it for a single guy. The single guy was Chandler, who was single and had $94,800. And we also need it for head of household for another guy named Lazier. All right, let's do the tax liability. Remember, he's single, so we need this one. Let's get the single rate. He makes $94,800. $94,800, let's go down here. $94,800 is between 84 and here it is, $94,800. So we know he's going to pay all these taxes. They've already got it computed for us. We know that, again, we're going to go down, he's going to owe at least $4,543, but we got to go up and he's in, by the way, I can tell you right now, it asks what is his marginal tax rate. You see, he's between 84 and 160. That's taxed at 24%. So his marginal tax rate is 24%. That's, again, every dollar. Marginal means every incremental dollar that he makes. The marginal dollars, as he makes more dollars, that's the tax rate that applies to him now because he's gotten up to that higher income. But the tax liability, well, that's going to be, again, just like we said here, the amount over 84.2. The amount, it says the amount over, you see again, that's where we're at, that's the bracket we're in. The amount over 84.2 plus this amount. So let's take it. The tax is $14,382.50 plus 24% the amount over this. So let's just write that in a formula. $14,382.50, $14,382.50 plus, now he's making $94,800, the amount over, $94,800. And how much is he making over 84.2? Minus 84,200. Now we want to take those and subtract them and then multiply them by 24% times 24%. We want to do that all first. And then we want to add that to this amount right here. And we will have, again, the tax liability. You see, we already know that from the first, second, and third bracket, he owes, from the first second and third bracket, he owes $14,382. That's what he owes already. But let's take 94,800 minus 84,200 and take that times 0.24%, and that's going to be 2544. So all of this comes to 2544, and we add that, and we'll get plus 14,382.5. This is going to be $16,926, $16,050. $16,926.50. That's the tax liability. The marginal tax rate is 24% because that's the bracket he's in. And then the average tax rate, let's take his taxes, $16,926.50, and divide that by his taxable income. That was his taxable income, $94,800. And that will tell us his average tax rate. And that's 16,926 divided by 94,800. That is going to be equal to 19.96%. So do you see what they're trying to show us, and what I'm trying to show you is that this guy has a margin. Every dollar he makes now, he's going to pay 24 cents on the dollar. But his average tax rate, do you see why it's average? It's not going to be that high because he's paid lower taxes. And he's got, and in these lower brackets, he's paid a lesser percentage, 10% than 12. But the average tax rate he's paying on the $94,800 he makes is 20%. So marginal tax rate 24, average tax rate 19%, really 20. Yeah, I'd round that up to 20%. And then his tax liability, let's again show that tax liability is right here. $16,926.50. All right. Now, let's go over and do that other side. And let's do this guy named Lazier. And let's see if we can get that over here. All right, Lazier, need a calculator. All right, now this guy's different. This guy is head of household, okay? Head of household, so we got to remember to use these rates. Now let's do again the tax liability. And the tax liability, he makes $57,050. So he's beyond this bracket, he's beyond the second, the 12% bracket, and he's in the 22% bracket. And he's right here, $57,050. He's between these two. Now his marginal rate is 22%, so we can write that down. MARGIN at marginal rate is equal to 22%. That's the rate that he now has to pay on every dollar. If he makes enough money, his marginal rate will be 24. If he makes more money, it'll be 32. All right, let's go get the tax liability. He's going to have to pay, for the first and second increment, he's going to have to pay $6,065. So it's $6,065 plus 22%, all right, plus 22, plus 22% of the amount over $52,850. So let's take the amount he's got. How much is he over? He's got $57,050. That's what he's making right there. How much is he over? $52,850? I don't know, $52,850. And we have to take that and multiply it times the bracket he's in, 22%, times 0.22. Again, we want to do this whole calculation and then add it to the first two brackets of tax, and we'll get the tax that is owed. So let's take a look at this. We've got 57,050 minus 52,850 is 4,200 times 0.22. That's $924. So this is going to be $924. Add that to the 6,065. and that is equal to 696989. $6,989 is the tax liability, all right? His marginal tax rate is 22% because that's what he's paying, and his average tax rate is, again, take the amount of tax he's paying, $6,989 over his total income, taxable income, 57,050, and take that, divide it, 57,050, and you get a rate of, an average rate of 12.25%. So there you have it. You see again, this guy's he's got a lower marginal rate, and look at his average tax rate, it's only 12%. That should be expected to some degree. This guy's making more money, and he's single. Again, this guy, they're not going to tax him. Lazar, they're not going to tax him as much because Congress is saying, let's be nice to this guy. Let's give him a little lower tax rates because he's the head of household. He's supporting some children and maybe an elderly person, who knows, qualifying relative. All right, that's all we're going to do, I think, on this tape, and then we're going to wrap up and do some even more complex stuff when we come back. I think I cut that off a little bit. Let me swing it around, yeah. Again, I didn't mean to cut that off, but when I did my computation over here a minute ago, when I did this computation, it came out to $6,989. That's the tax liability. This is what got cut off. And then you can see this in the other video. You take the tax liability, divide it by the total taxable income, and you get your average rate. So, sorry about cutting that off.